and welcome back to our Preparing for Retirement podcast. I'm your host, Mark Cram, Certified Financial Planner in Durham, North Carolina. And today's topic is going to be retirement plans. So, how have you been saving for your retirement? Have you been using the retirement plans that the government has recommended that we all take part in? Well, do you know what to expect from these retirement plans when you get ready to start pulling your money out? And will it be enough by the time that you get to retirement? Well, let's look. The basic retirement plans that are out there for all of us to put our money away in are IRAs and 401ks. The majority of the population can take part in these plans either through their own payroll deduction or through a private retirement plan at a bank or mutual fund. Typically, how these contributions have been promoted is that your contributions are tax favored. That is, you either get a tax deduction in the case of an IRA, or you can put money in tax-free in the case of your 401k plan. Second is that the money accumulates tax-free. That is, it's a tax-deferred accumulation so that the money grows faster and there should be more money in there by the time you get to retirement. So, for the most part, we have been concentrating on contribution and accumulation as we've been thinking about and funding our own retirement plans. And of course, in that particular phase, the tax-favored treatment has become very important. However, as more and more people are approaching their own retirement, and as the baby boomers start entering into their retirement phase, we are now starting to take a closer and closer look at the next two phases of retirement planning. That is withdrawal, and in this case, if we pull money out of these plans to provide income for us in retirement, it's going to be taxed, and it'll be taxed at whatever tax rate you happen to be at when you reach retirement. And if you transfer this money to heirs other than your spouse, it's going to get taxed again. And here is where the issue comes in, because we have been told that we should use these plans because we can accumulate more money, and when we retire, we will be in a lower tax bracket. Well, how many of you believe we will be in a lower tax bracket? Well, if you've been with me up to this point, you're probably of the opinion that taxes are probably going to be higher in the future, not lower. So let's look at really the rest of the story. What can you expect from your IRAs and 401ks? Well, if you were able to save $300 a month over 30 years, you would have put away $108,000. If that money could grow at 10%, you would have $684,000 at retirement time. Now, if you were in a marginal 30% tax bracket during that 30-year time period, you would have saved $1,080 every year. Now, 30% tax bracket, I'm assuming 23% federal tax bracket and a 7% state tax bracket. If yours is higher or lower, you can calculate this number for yourself. Over 30 years in a 30% tax bracket, you would have saved $32,400 in taxes. Not a small number by any means. But let's look at the rest of the story. Your $684,000 in retirement, if you were still earning 10% on it, would mean that you could generate an income of $68,400 from that nest egg without touching the principal. If your marginal tax bracket just stayed the same and you were still paying 30% in taxes, the very first year you retired, you would pay $20,520 in taxes. And if it stayed the same going forward, you would pay that each year in retirement. Your net income would be $47,880. Now, if you live 20 years in retirement, that means you're going to pay $410,400 in taxes versus $32,400 that you saved during the 30 years that you accumulated that money. That's over 12 times what you saved in taxes over that 30 years. And that's just if your taxes stay the same. If your taxes and your tax bracket go up in retirement, you could expect that you will be paying much more than that in taxes. So as you prepare for retirement and think about your retirement plans, you probably are going to need a larger nest egg than what you have been accumulating up to this point, which means you may need to put more money away. You also are going to need more income from that nest egg if in fact taxes are going to be higher, or even if they're just the same. If you want to create the same income as you have today, you're going to need more income. And of course, you're going to need that money to be safe. You're not going to be willing or able to lose any of that principal that you're going to need to be able to provide an income for you in retirement. So maybe saving for retirement in a tax-free environment versus a taxable environment might make more sense going forward. And we will look at this in future podcasts. For now, if you want more information about these concepts, please go to the website www.equitymaximization.com. That's www.equitymaximization.com. And I'll be back next time to help you prepare for your retirement.